Now, as we move through our model, we're going to simply be adding more accounts to our statement of cash flows. In this case, our second tab added inventory. So here, what we want to add is the change in inventory to our account. So here we notice that if we visually look at it, our change in inventory is nothing. It went from 400 to 400, but we still want to think about it, so we set up our equation properly. And what is important here is that we think about what side of the balance sheet inventory is on relative to cash. And because they're on the same side of the balance sheet, an increase in inventory must be offset by a corresponding decrease in cash. So if inventory goes up, cash has to come down because there's nothing that's moving on the liabilities and equity side of the balance sheet. Both are on the asset side, so they have to move in opposite directions. So in this case, if we're going to set up our account, we want to do a negative to reflect that any increase in inventory is going to be a negative or decrease in cash. So here we're just going to do a negative of the ending balance of inventory minus the beginning balance. Close that off, and we get a 0. Our cash flow from operations, we can now update to just simply sum up all the different cash flows we have in that category. And then our model updates, and we see that our ending cash is actually not accurate, right? We had a change in our beginning balance of cash, so we want to be careful. Let's link that back to our beginning cash in period 0. And now we see that our cash flow statement matches that 1600, what we have on the balance sheet. Now moving to the next tab, we're simply adding more accounts into the cash flow from operations. So let's review each of these. Change in inventory, we have the same equation we had before. Now change in accounts receivable, let's actually work through this and the change in accounts payable because they're going to go in opposite directions. For change in accounts receivable, it's on the same side of the balance sheet as cash. So again, if it increases, cash has to decrease. That means we're going to have a negative of our change in accounts receivable, which will be our beginning of the period, our end of the period minus our beginning of the period. That'll be the increase in accounts receivable. And so here we see negative 800. So it's always worth stopping and thinking, does that make sense? So here, negative 800 means that accounts receivable must have gone up by 800, which is a use of cash of 800, right? The reason it's a use of cash, one, they're on the same side of the balance sheet. That's the mechanical reason. Kind of the conceptual reason is that whenever you get accounts receivable, that means that you sold something to a customer and they haven't paid you yet. So if they would have paid you in cash, you would have $800 more cash, but instead they are delaying paying you. Essentially, you're lending them credit, so they're using $800 of your cash and that they have not paid that to you yet, even though you already made the sale. So that's the sense in which it is a use of cash. We never got it and we didn't actually use it for anything. It's just that we've foregone our ability to use it by extending credit to our customers. Now the flip side of that is accounts payable. For accounts payable, since when it goes up, cash also goes up because they're on opposite sides of the balance sheet, we can actually just do a straight end of period balance minus beginning, ending minus beginning. And here we see that accounts payable increased by $1,600. The $1,600 increase, that reflects additional cash that we have. And it's because we didn't use our cash yet, right? By having accounts payable, that's like getting a loan from our suppliers, right? They've provided us materials, they've charged us for them, and they've sold them to us. We just haven't had to pay yet. And because we haven't had to pay yet, we have more cash in our pocket. It increases our cash flow from operations. So now we can see our cash flow from operations is simply summing up all the different sub-items of cash flows. Our beginning balance of cash, here we're back and correct at 0. Our change in cash is simply from the operations at this point. And our ending cash matches our balance sheet end of period balance.